Alberta is racing to lock new export routes for its oil, a move that could redraw North American energy politics and reshape livelihoods across the prairies. For decades, Alberta's oil has flowed south into U.S. refineries. Today, that dependency is a strategic vulnerability and a political flashpoint. The province is pushing hard to diversify, courting Pacific markets, courting foreign refiners, and quietly lining up private sector proposals that would send Alberta crude to Tidewater and to buyers beyond the United States. Those ships matter because they change who pays Alberta's bills, who hires Alberta workers, and who writes the rules for Canada's energy future. This isn't abstract policy, it's an economic imperative. Alberta already ships millions of barrels every day into the United States, and provincial leaders say expanding export capacity would sharply improve prices for producers and revenue for governments. That's why premiers and industry leaders are no longer content to wait for a federal green light. They are building proposals, courting investors, and asking one simple question: if Ottawa won't act, who will secure our markets? At the center of the debate are three practical realities. First, pipelines take years to permit and build, and political objections anywhere along a route can stop projects cold. Second, global buyers want reliable, refined product, not raw politics, which is why Alberta is exploring investments in foreign refining and partnerships that would make its heavy crude easier to market overseas. Third, U.S. policy changes have opened narrow windows. Recent permits and executive actions in Washington have revived cross-border pipeline conversations, creating opportunities Alberta hopes to seize. The proposals on the table differ in scale and strategy. Some argue for reviving or expanding existing north-south corridors to the American Midwest and Gulf Coast. Others favor a new Tidewater route to British Columbia that would free Alberta from near-total reliance on one customer. Private companies have also floated smaller, targeted projects, expansions of existing lines, new connections at border points, and partnerships with U.S. refiners that would guarantee offtake. The logic is simple: diversify outlets, lock in long-term contracts, and reduce price discounts driven by transport constraints. But the path forward is clogged with legal, political, and social obstacles. Environmental reviews remain a major hurdle. Indigenous nations and environmental groups demand meaningful consultation and robust safeguards. Without those, projects face court challenges and costly delays. Provinces pushing ahead must also navigate constitutional lines. Provinces can enter commercial agreements with private entities, but international trade and border crossings traditionally involve federal authority. The result is a high-stakes legal chess match with jobs, revenues, and national unity on the board. That tension explains why Alberta's leaders are doubling down on two parallel strategies: build market options through private and provincial initiatives, and press Ottawa to streamline approvals and back major infrastructure. The pitch to the federal government is pragmatic: help remove barriers for projects that are safe, economically beneficial, and accompanied by credible emissions reduction commitments, including carbon capture, higher environmental standards, and Indigenous equity participation. In return, the province promises jobs, royalties, and long-term partnerships that could modernize the oil patch. Critics say this approach risks short-term gain at long-term cost. Environmental organizations warn that new export capacity will lock in carbon-intensive production for decades, undermining Canada's climate commitments and international credibility. Skeptics also point out that global oil demand forecasts are volatile. A heavy investment in more pipelines could leave Alberta exposed if markets shift or if investors demand cleaner fuels faster than anticipated. Those are real risks that must be weighed against the immediate economic pain of constrained markets. Still, the political reality in Alberta is stark. Communities hit hardest by low prices and reduced investment want action now. Jobs, local procurement, and tax receipts can't be deferred for political perfection. That urgency explains why provincial governments are exploring creative deals: equity partnerships with Indigenous groups, incentive packages to attract pipeline proponents, and export initiatives aimed at Asia and Mexico as potential customers. Each option carries trade-offs, but together they represent a clear strategic pivot: diversify markets or accept prolonged economic pain. What happens next will depend on three decisions: whether proponents can deliver bankable projects that clear environmental reviews and secure Indigenous consent, whether Ottawa will reform approval processes and offer constructive federal support, and whether international buyers will commit to long-term contracts that justify the billions pipelines cost. If the answer to those questions is yes, Alberta can reduce its single market vulnerability and reshape its bargaining power. If not, the province will face renewed pressure to reconcile energy ambitions with environmental obligations. For listeners trying to make sense of the headlines, the takeaway is straightforward. Alberta's push to diversify exports is not a stunt. It's a strategic response to market realities and political frustration. It poses hard questions for Ottawa, for Indigenous nations, and for investors weighing climate risk against economic returns. This moment demands sober, transparent choices, rigorous environmental standards, genuine consultation, and clear fiscal planning, alongside realistic market strategies. Done right, Alberta can secure jobs and revenue while improving environmental performance. Done wrong, the province risks costly delays, legal fights, and reputational damage. The stakes are high. The choices are urgent.